Have you ever wondered why truly wealthy people, they just seem to operate in a completely different financial reality?
Oh, absolutely.
It's not just that they're richer, it's like they're playing by a set of rules that most of us don't even know exist. It's a real psychological puzzle.
It is. And I think, most people see wealth building as this linear thing, a straight line up.
Right. You earn a little more, you save a little more, step
Uh,
by step.
exactly. But the data we've been analyzing, it clearly shows a nonlinear shift.
Hmm.
There is a specific point, a threshold, where money stops being something you have to chase.
And it starts working for you instead.
It starts working for you 24 hours a day.
And today we're going to do a deep dive into that exact threshold.
Ah.
$1 million invested. And look, this is crucial. We're not talking about net worth, which, includes your house or your car.
No. And we're not talking about lifetime earnings either. This is
Yeah.
$1 million of pure working capital, money that's out there generating more money.
That's the transformation.
It is the fundamental transformation. You don't just have more money, the whole economic game changes for you, and you have to adopt a totally new strategy.
So the key insight we want you to walk away with today is this. Wealth building is not linear.
Hitting this number changes you from someone who trades time for money into someone who owns capital, an entity that generates revenue all on its own.
And if this kind of thinking is valuable to you, this is probably the best time to make sure you're subscribed so you don't miss what we uncover next. Because we are about to hit the hard numbers that prove this is real.
Okay, let's start with the math, because, this is the proof, right?
It's the foundation of everything.
We're going to look at the power of compounding at a pretty standard, pretty conservative 7% annual return. We need to see that jump from just contributing to actually funding a lifestyle.
Okay, so let's start small. Say you have $10,000 invested. A 7% return on that generates about $700 a year.
$700. That's nice. It's a nice dinner, maybe a weekend trip,
Mm-hmm.
but it's not changing your life. Not at all. Your job is still providing, 99% of your income? You are completely dependent on your labor.
Okay, so let's bump that up. Let's say $50,000 invested.
Now you're generating about $3,500 annually. That's
Uh-huh.
more helpful. Maybe it covers your property taxes or, a big insurance bill.
But again, if you lost your job tomorrow, $3,500 wouldn't even cover 1 month of expenses for the average American family. You're still totally reliant on that paycheck.
But now,
Yeah.
apply that exact same 7% return to $1 million invested. Suddenly, that capital is generating $70,000 per year.
$70,000. Just think about that jump for a second. 3,500 versus 70,000. It's the same percentage, but the scale it feels totally different.
It's a different world. Your capital, your financial employee, is now making more gross income than the median U.S. individual earner. And it doesn't take sick days. It doesn't ask for a raise.
And the practical side of this is, it's just staggering. Recent analysis puts the average American household's expenses at around, $67,000 a year?
Right around there.
Yeah.
So for the first time, your invested capital isn't just a bonus. It's not just a safety net. It's actually capable of funding your entire middle-class lifestyle.
Wow.
And that is the first true wealth threshold. That's where capital starts to outperform labor for most people. And it cements that identity shift from saver to owner.
So once that math sinks in, that's when the real work starts, right? The psychological shift.
Oh yeah, this is the big one.
It's a crucial difference between having a saver mentality and a capital owner mentality.
Yeah.
And they're basically opposites.
Completely. The
Yeah.
saver is all offense. Their whole strategy is accumulation.
Just add to the pile.
Add to the pile, save as much as you can, take high risks, because the potential upside of getting rich feels bigger than the downside of losing what you have. They're still trying to get rich.
But the moment you cross that $1 million line in liquid working assets, you are now officially rich.
You've arrived.
And the focus has to pivot immediately from, aggressive growth to preservation to optimization. It's a defense-first game.
And that shift is so incredibly hard. The very risk-taking that got you there is now the thing that could destroy it all.
Absolutely. The way you even perceive risk just gets turned on its head.
Right. So if the market drops 10%, the saver with, say, $20,000 loses $2,000.
Okay, that hurts, but you can earn that back in a few paychecks. It's recoverable.
Exactly. But the new capital owner sees that same 10% drop, and they lose $100,000.
$100,000. That's, for a lot of people, that's 2 years of salary. Gone. Overnight.
All of a sudden, market volatility has this this real physical weight to it. And if you lose that 100 grand, you have to earn 100 grand back just to break even.
And what's really fascinating is how your perspective on those downturns completely flips.
Yes. The saver panics.
Yes.
They're worried about their future, their retirement. The capital owner, though, with that $70,000 passive income buffer, they're not worried about survival.
They start seeing opportunities.
Opportunities. That cushion lets them step in and buy asset, stocks, real estate, whatever, at a huge discount, right when everyone else is scared and forced to sell.
And that cushion leads us right into what we call the optionality mindset. This might be the most valuable thing you get. It's the ability to work from a position of strength, never from desperation.
Yeah, and even if you keep your job, and a lot of people do, they enjoy it, your whole relationship with that job just changes, fundamentally.
You're not trading your time for a paycheck because you have to anymore.
Every single decision, every meeting, every project, it becomes a choice.
That gives you unbelievable negotiating power. I mean, imagine walking into a salary negotiation knowing that if they say no, you can just walk away.
And be totally fine, because your investments are already generating 70 grand a year to cover your life. That lack of desperation, it changes your entire demeanor, and you often get better outcomes because of it.
It also creates this incredible safety net for taking calculated risks.
Huge risks. You can finally afford to start that business you've been dreaming about, or switch to a lower-paying career that's more fulfilling.
And if it fails?
If it fails, you don't face financial ruin. You go back to your $70,000 passive income while your assets keep growing. Your worst-case scenario is just your old baseline.
This is such a powerful concept. And look, if this analysis is providing real value for you, this is a great time to just take a second to make sure you're following along so you don't miss our future deep dives. Because what we're about to get into, this reevaluation of time, is maybe the biggest prize of all.
It really is. But for $1 million, every hour you're not working feels like a missed opportunity. You're always calculating the cost of leisure.
But after $1 million,
the calculation flips. Time becomes the scarce resource, not money. Since your capital is handling the basics, you start making choices that maximize your life satisfaction.
Working fewer hours, taking longer vacations,
pursuing hobbies that don't make any money at all. You realize your time is just more valuable than that extra dollar you could earn by grinding it out.
Okay, let's talk about the key that this $1 million threshold unlocks: high barrier investment opportunities. This is where the wealthy are playing a completely different game.
Exactly. The minimum capital requirement is basically the bouncer at the door of the club.
Right. When you have less than, say, $100,000, you're pretty much stuck with public markets, stocks, bonds, ETFs.
But once you have substantial capital, you get access to institutional level deals.
Yeah.
We're talking about things like private equity funds, where you're buying stakes in private companies, or complex real estate syndications, pooling money to buy massive commercial buildings.
And those investments, they often have minimums of $50,000, $100,000 just to get in.
Right. And if your whole portfolio is only $200,000, putting half of it into one illiquid asset is just, it's way too risky.
But with $1 million, you can comfortably put 5% or 10% into 5 different alternative deals without, risking your whole financial stability.
It's a level of diversification that small investors just can't touch.
And the leverage. The way banks see you, it completely shifts.
Oh, completely. You go from being a risk to being a preferred customer. You get better terms on loans, lower rate lines of credit, personalized service. This is how the wealthy use their money to get access to more money to buy more assets.
But we have to talk about the flip side, the counterintuitive part. For a lot of people, the anxiety actually goes up when they cross $1 million. Why? Why, if they're so much safer?
Because the dollar amounts are just. They're terrifying. A simple 5% market drop isn't $2,500 anymore. It's $50,000.
Wow. That's more than a lot of people earn in an entire year.
And you're now watching the daily swings in your portfolio be bigger than most people's monthly salary.
But if you know that 70 grand is still coming in passively, why does seeing a $50,000 drop on paper cause so much stress?
It's that preservation mindset kicking into overdrive. $50,000 might be a paper loss today. But what if there's a deep correction, a 20% drop?
Yeah.
Now you've lost $200,000.
Okay.
And the time it takes to recover that, even with compounding, is significant. The aggressive strategy that got you to $1 million is now your worst enemy. You have to play defense, and that feels completely unnatural to the person who spent decades on offense. It leads to a lot of stress.
And yet, despite that new anxiety, the math of compound acceleration is just It's undeniable.
It's the best part. Hitting the first million is almost always the slowest, hardest part of the journey.
Because of that large base, right?
Exactly. If your $1 million grows by just 8% in 1 year, that's $80,000 you earned without contributing a single new cent.
Think about that. Someone saving $10,000 a year for retirement. Your portfolio just earned 8 years worth of their contributions in 1 year of just growth.
This is why the second million and the third comes so much faster than the first. The first million might take 15, 20 years of intense saving
But the next one might only take 5 to 7 years.
because the base itself is doing all the heavy lifting. And at that scale, optimization becomes everything. Tax strategy stops being a chore you do in April.
And it becomes a core part of your financial plan.
Yes. The difference between paying a 15% capital gains tax versus a 25% income tax. That could be tens of thousands of dollars saved every single year.
And we're talking about sophisticated stuff here, like tax loss harvesting, right?
For sure. Selling assets at a loss to offset gains. Or asset location, putting high-growth things in tax-advantaged accounts. These strategies are barely worth the effort when you have a small portfolio.
But they become absolutely essential when you're managing $1 million or more.
And finally, your focus can shift to legacy. When you were saving your first 100,000, it was all about your own security.
Getting out of scarcity mode.
Exactly. But at $1 million invested, you are now the steward of capital that can outlive you. It can generate value for your kids, for charity, for generations. A $10,000 home repair doesn't even cause a blip of anxiety.
Because your $70,000 passive income replaces that money in just a couple of months.
That is true financial breathing room.
So what does this all mean for you? The $1 million invested threshold is so much more than a number on a screen. It's a true fork in the road.
A fundamental shift in your relationship with money, with risk, and especially with your own time.
You change from being an accumulator, trading your life for a paycheck, to becoming a capital owner. Your money is now working harder than most people do at their jobs.
And understanding that shift, that is the real roadmap to financial independence.
And that leads us to our final provocative thought for you to think about. True financial freedom isn't really about having the money to buy more stuff, is it?
Yep.
It's about having that financial foundation, that $70,000 safety net that allows you to bet on yourself, to take career risks, to pursue meaningful things in a way that would be totally reckless for anyone else.
Think about that inversion of risk and opportunity. If you found value in this deep dive, make sure you share this with someone else who's on that climb toward that critical $1 million mark. We'll be back soon with another deep dive.